Let's talk about Ray Dalio and crypto portfolio diversification. Before we dive into the statistics behind portfolio diversification, I need to do a quick little recap on who is Ray Dalio. Ray Dalio grew up in a middle-class Long Island neighborhood and started playing the market at the age of 12 after getting tips from golfers who he caddied for. In 1975, after earning an MBA from Harvard Business School, Ray Dalio launched Bridgewater & Associates from his two-bedroom apartment in New York. Bridgewater Associates is now currently the world's largest hedge fund firm with over $154 billion worth of assets that they manage. Now that we obviously understand that Ray Dalio is overqualified to be giving us investment advice, let me play a few quick clips that'll actually explain how portfolio diversification works and how we can use those statistics to our advantage.
The real question for me was, what were the marginal benefits of diversification like? What is that going to look like? Think about risk and the number of sample size and the correlation of the bets, broke it down to each of its components. To use an example, let's assume you have something that has a 10% risk. We'll call risk standard deviation. And let's make it simple, and let's say it had a 10% return. And let's say I add in another asset. I add in a second, a third, a fourth, a fifth, up to whatever number. How would that reduce my risk if it on average has a 60% correlation, or if it has on average has a 40% correlation, or a 0% correlation? How would that change? Wanted to know that, right? That's what this chart shows, right? So imagine you have a 10% average return. You don't know which bet is going to be better, has a 10% average return and a 10% risk, and you add in a second and a third and so on. You're not going to lose the 10% because you're still going to have that 10% return, but you're going to then have a reduction, and that's the reduction in risk. And if it has a 60% correlation and you have 3 or 4, you will get a reduction that maybe is about 15%. And you could add in 1,000 if they're 60% correlated, and you're not going to reduce your risk much. Okay, that's important. Now, if I look at that, how that changes according to the levels of the correlation, I start to think, well, what would happen if I added in something that had a 10% correlation, by way of example? Okay, now that's what that line shows, okay? And it shows how much, okay, at about 7 or 8 or so, I cut my risk in half. That means I've doubled my return relative to my risk, right? Ooh, that's good. So as I go down this, I then start to understand what the power of diversification is in terms of the things that I'm going to look for. So what that taught me is the magic is you only need to do this simple thing. The simple thing is to find 15 or 20 good uncorrelated return streams, things that are probably going to make money, but you don't know, but they have a good probability of making money, that are uncorrelated, that have low correlation. That told me that's what I have to go after. That's the key. A lot of people think that the most important thing you could do is find the best investment, okay? That's important, okay, but there is no great one best investment that can compete with something like this. So look at this line. When this comes down, you can improve your return to risk ratio by a factor of 5, right? 5 times the expected return for that unit of risk. You can't pick any investments that are probably, nobody's humanly capable in an efficient market probably, to pick investments that are 5 times as good individually, but so that path. So it tells me about the power of diversification and balancing risk. So this is the return to risk ratio that happens for each one of those. You know, like if I can get 0 correlation and I have 15 to 20, I'll have an information ratio, a return to risk ratio of 1.25. That means my probability of losing money in a year is only 11%, okay? As distinct from 40% with any one of us. So that's the power of portfolio construction and the power of diversification, okay? So it tells me what I have to go after.
Whoa, that's a lot to take in there. I could spend the next 30 minutes attempting to explain what an annual portfolio standard deviation is, how to calculate proper risk of a crypto asset in your portfolio, but unfortunately this video can't be over 7 minutes. So let's do a quick little recap on what Ray just explained. Number 1, portfolio diversification is good to a certain extent. If you notice the curve that we see here on the graph, if you diversify assets that are correlated, it does very little to reduce your risk to the downside. The next question you're going to ask is, what are correlated assets? Correlated assets are assets that move together. For example, taking a look at a coin like Bitcoin and Litecoin. Anytime Bitcoin's going up, Litecoin's going up. Anytime Bitcoin's going down, Litecoin's going down. Now let's take a look at something like Luna. I mean, how many times have we seen Luna just take off and separate from Bitcoin and go parabolic? We can see here in August of 2021, November of 2021, January of 2022, a lot of times. So you can see that those assets, yes, Bitcoin will move up and Luna will move up at the same time, but there are those times where Luna completely separates itself when Bitcoin is completely bearish and Luna starts running up, and not just running up, but running up and putting in new all-time highs when the markets are bearish. That is an uncorrelated asset. Now, if we take a look at the chart one more time, we can see that if we have 5 assets that have a 0% correlation, then you reduce your risk to the downside by about 70%. That would lead me to believe that 5 assets would be the sweet spot, but this is crypto and almost every asset is correlated to Bitcoin in one way or another. We can also see that with a proper diversified portfolio, if you have 10 separate assets that have very little correlation, that would be the best general portfolio structure that we could aim for. So the purpose of diversification is to reduce your risk to the downside. Instead of having quote unquote all of your eggs in one basket, you diversify. But the purpose of diversification is to limit your risk to the downside. So when you have assets that move directly in correlation with each other, there's no purpose in having Solana and Matic in your portfolio if they are both a layer 1 project, their technology is similar, and they're both chasing the same end result. Taking a look at a project like Kadena and a project like Flux, they may even move in correlation and go up, but they are completely different asset classes. One is focusing on Web3, one is focused on being the main layer 1 ecosystem. So these are just some key tips, but I've personally made a lot of mistakes investing in crypto, and they all were correlated to just being way too over diversified. Having $200 of Crow and having $200 of Uniswap and having $200 of PancakeSwap and having $500 of this DEX and $500 of that DEX and Radium and Solana and Serum and Bake and Elf Zero and all these new projects that are coming out. Over diversification destroyed my portfolio. So keep these key tips in mind. If I were you guys and I was new to crypto, as you start growing, pay really close attention to what assets that you're actually adding to your portfolio. All of these little key pieces will go a really long way in helping you guys be successful as crypto traders. Love you guys. Can't wait to see you guys next video. Peace.